1 million euros, 40,000 a year, principal untouched. That is what Mike Petry built his portfolio to deliver. And the structure he used is not what most people think. Most people reach for dividend ETFs too early, using an income tool during a growth phase. And then they wonder why nothing is growing fast enough. Mike Petry, the creator behind Nobody Told Mike, does not make that mistake. Here's exactly how he avoided it. In episode 1 of Nobody Told Mike, Mike explained ETF investing, what an ETF is. A basket of companies, low cost, one of the most powerful investment tools available to ordinary people. But he did not show you his own portfolio. What NTM told us exists to show you exactly that. The technical layer, the architecture behind the Nobody Told Mike philosophy. Before understanding the portfolio, you need to understand what it is built to achieve. Mike's target, the goal he talks about openly on Nobody Told Mike, is 1 million euros in invested assets. At 1 million euros, a 4% annual dividend yield generates 40,000 euros per year in passive income, without selling a single share. The principal is untouched. The income continues indefinitely. That is not retirement. That is the removal of financial necessity. The choice to work becomes entirely yours. This is the 4% rule, and it sets the entire logic of how the portfolio is structured today. Think of the portfolio as two engines. Engine 1 builds the portfolio, fast growth, higher volatility, maximum compounding. Engine 2 powers the income, dividends, stability, the reward for getting there. Right now, Mike is running Engine 1 at full power. Engine 2 is idling, small, ready, waiting for the moment the portfolio reaches its target. As the portfolio grows toward 1 million euros, Engine 1 gradually slows. Engine 2 takes over. The transition is deliberate and slow, not a single switch, but a gradual handover over years. Chapter 1. The 5 allocations. Mike's portfolio, the real portfolio behind the Nobody Told Mike philosophy, is divided into 5 categories. Each one serves a specific purpose in the two-engine structure. Allocation 1, Growth ETFs, 50%, the largest allocation. The core of Engine 1. Growth ETFs track indices focused on companies with high earnings growth potential, technology-heavy, innovation-focused, higher short-term volatility, significantly higher return potential over the long term. These are among the best growth ETFs for the accumulation phase. ETFs tracking the NASDAQ 100 or global technology and innovation indices are typical examples. 50% is an aggressive position. It reflects the current phase. The portfolio is too small to generate meaningful income, so the priority is compounding growth as fast as responsibly possible. Higher growth potential means accepting higher short-term swings. Mike accepts that trade-off deliberately. Allocation 2, S&P 500 ETF, 20%. The S&P 500 ETF tracks 500 of the largest U.S. companies. Approximately 60% of the growth ETF holdings are already included in the S&P 500. There is deliberate overlap here. This is not a mistake. It is an intentional overweight on U.S. market exposure. More on this in a moment. Allocation 3, Dividend ETFs. 10% a small current allocation to dividend-focused ETFs. More mature businesses, lower growth, regular income payments. At 10% today, this is Engine 2 idling. As the portfolio approaches the 1 million target, this allocation will grow significantly. This is how Mike structures a dividend portfolio that actually makes sense for the growth phase. Small now, dominant later. Allocation 4, individual dividend stocks, 10%. 10% in individual company shares chosen specifically for their dividend track record. Higher attention required than ETFs. Individual companies carry more concentration risk. The purpose is to supplement dividend income with direct conviction positions. Allocation 5, bonds, 10%, the stabilizer. Bond ETFs move differently to equities, often rising when stock markets fall. 10% in bonds reduces overall portfolio volatility. As the portfolio matures and the horizon shortens, this allocation increases. Chapter 2. The overlap. And where most investors go wrong. The S&P 500 position raises the most common question about this portfolio. If 60% of the Growth ETF already contains S&P 500 holdings, why add a dedicated S&P 500 ETF on top? The answer is conviction. Mike has made the judgment that U.S. large-cap equities will continue to drive global market returns in this phase of his investment horizon. The overlap is intentional concentration, not duplication. Here is where most investors go wrong. They see overlap in their portfolio and panic. They assume they have made an error. They rebalance, remove the position, and end up with less U.S. exposure than they actually want. The overlap is not the mistake. Removing it without understanding why it is there, that is the mistake. Every portfolio is a set of deliberate bets. The only question is whether the bets are conscious or accidental. In this case, the overlap is fully conscious. Let that sink in. Conscious overlap is a position. Accidental overlap is a mistake. Know which one you have. If this two-engine framework is making sense so far, hit like. It helps more people find exactly this kind of portfolio breakdown. Chapter 3: How the Portfolio Evolves. This allocation is phase-specific. It is not permanent. As the portfolio grows toward 1 million euros, the throttle gradually shifts from engine 1 to engine 2. Growth ETF exposure reduces. Dividend ETF and individual stock allocations increase. Bond allocation grows as capital preservation becomes more important than capital growth. The destination portfolio looks broadly like this. Lower growth ETF exposure, significantly higher dividend income allocation, higher bond stability, and a total yield of approximately 4%, generating the passive income target. 2 portfolios, 2 phases, 1 goal. Mike's portfolio is not a template. It is the real portfolio behind Nobody Told Mike. A decision made at a specific point in time for a specific goal with a specific risk tolerance and timeline. The allocation will look wrong to some people. Too aggressive in growth. Too much U.S. exposure. Not enough bonds yet. That is fine. Every portfolio should reflect the person behind it, their goal, their phase, and the trade-offs they are willing to make consciously. What matters is not the specific percentages. What matters is having a structure, a reason for every allocation, a goal every position serves, and a plan for how it evolves. The number is 1 million euros. The income is 40,000 a year. The principal stays. The choice to work becomes yours. That is what Mike Petry is building toward. And that is the philosophy behind Nobody Told Mike. Here is the question for the comments. Do you know what phase your portfolio is in right now? Growth or income? Be honest. And if you want the foundation this portfolio is built on, watch the original ETF story on Nobody Told Mike. Link below. See you in the next one.